Thank you everyone for joining us. We appreciate your time and interest in hearing from us here at Sculptor. I'm Victoria Kinlan from Sculptor's Client Partner Group, and I'm thrilled to be joined by our CIO, Jimmy Levin. This conversation comes at a critical time, and therefore we look forward to hearing his latest views on the current market landscape and outlook for the rest of 2025. With that said, let's get started. Jimmy, to begin the conversation, it would be helpful to rewind the clock to understand Sculptor's perspectives on the market environment coming into the year, in what was largely viewed at the time to be a market-friendly backdrop with the new administration. Can you take us back to the start of 2025?
Definitely. Although I think to really appreciate the story, we probably need to go back even further than the start of 2025. Really zoom out over the last couple of years. Throughout 2023 and 2024, our view had been the fundamental economy was actually quite strong and improving over that period of time. Although the main risk the economy faced was really inflation. And with inflation comes a rate response, and with a rate response comes a valuation impact. And so whether inflation was a problem solved or a problem to be solved was really the primary issue facing markets over that period of time. And our view had been that as a result of inflation being higher, rates were higher. As a result of rates being higher, spreads were higher, complexity premia were higher, and the opportunity to deploy capital really across markets to harvest those higher rates, higher spreads, higher complexity premia was very attractive. And in fact, doing so did not really require having perfect insight into whether the economy was going to continue to be great or could slow down, or whether inflation was solved as a problem or not solved as a problem. Meaning, in the credit world, by taking more senior risk, we didn't feel that we would be directly exposed to the exact outcome. We didn't need to be so right. And in our convertible bond arbitrage or other volatility arbitrage strategies, that type of directional risk wasn't required. It was more about idiosyncratic risk and more about harvesting that elevated spread, elevated rate, and elevated total return environment. As things proceeded towards the end of 2024, up to the election really, our view had been that regardless of how the presidential election went, we could be in a inflationary environment. Said differently, both candidates would have a possibly inflationary agenda, and the market wasn't necessarily as concerned, we felt, as we were. And then the election happened, and not only was there a Trump victory, but there was a red sweep. And our view became even more strong, because at that point, we felt that inflation was an even greater risk, that the policies that were beginning to come out of the administration, supported by that sweep, so there was a full mandate behind those policies, were essentially inflationary across the boards. The stance on immigration, inflationary. The stance on global trade, which at that time was quite mild relative to what transpired later, was inflationary. The stance on onshoring and reshoring, inflationary. The stance, even on tax policy, inflationary. And so we looked at all these policies that could be inflationary. We paired that with a pre-existing view that inflation remained the primary risk to growth, and that made us feel even more cautious. Against that, market participants across all markets, so investors, whether that's public markets, private markets, equity markets, credit markets, became wildly enthusiastic about the Trump administration, about the red sweep, about the policies. There was a exuberance around the pro-business environment, an exuberance around growth, about the unleashing of animal spirits in the economy or in the markets. As we digested all that, think about that phrase, happiness equals expectations versus reality. And the same applies for markets. Expectations were really high. Expectations were that growth would be stimulated massively and animal spirits unleashed unhindered, those were all happening already in markets. So markets were already pricing that, and companies were already acting that way. We think about the largest companies in the world were announcing $50 to $100 billion of annual CapEx spend on the AI theme without any near-term revenue to show for it. Likely will turn out to be great investments for those companies, but certainly a sign that animal spirits were already in full force. So if animal spirits were already raging through the system and valuations were high and spreads were becoming tight and the main risk in the economy was inflation and the policies were all inflationary, that led us to want to dial back risk in all the different ways that we dialed back risk, not necessarily because we predicted what ultimately transpired with Liberation Day and afterwards, but just because the various markets in which we participate weren't offering enough compensation for that risk. And so we became more cautious, and that left us ultimately in a terrific position as the real volatility began in March and April, as the trade policy moved both forward and escalated.
Conditions clearly changed quite rapidly in the market. How do you interpret the events from late March into April in terms of market impact, severity, and implications, especially given how fast the rebound was?
So that question requires different answers as we move from late March into late April and then into May, because the market changed, the news changed rapidly. The market adjusted rapidly. The news changed as much in a good way as it had changed in what was a concerning way for the market. And so there's been quite a retracement, but maybe taking that from the beginning, think about everything we discussed of just how good everything was before the Liberation Day related scare, meaning not just good in the economy, jobs, earnings, growth, margins, all of these elements of the underlying economy, consumer strength, housing, were exceptionally great. And the markets, again, were pricing for that. And so it went from that environment to an environment of fear incredibly rapidly. In fact, in a record-setting fashion, down days in a row in markets, up days in a row in volatility. Records were being set almost every day post-Liberation Day. And during that period of time, we saw overall price action in markets, again, most immediately in public markets, but ultimately working their way through all markets. We saw price action that looked fairly crisis-like, meaning peak to trough, the S&P 500 went down almost 25%. And peak to trough, high yield spreads nearly doubled. And peak to trough, volatility nearly quadrupled. These are major moves. These are the type of moves historically we would all associate with market crashes, with recessions, with major market events. So all of that transpired during April, and it transpired quite quickly. Now, the response to that was, in a way, a dilution or a softening of many of the policies or approaches that put the market into such a fearful position so quickly. So our sense, and this is how we navigated through the period, is that those are related, meaning the response from the market, the crashing in equities, the record-setting moves in swap spreads, the implications that may have had on the Treasury market or the U.S. government's ability to fund itself, or the relationship between the U.S. government and its foreign creditors, all of that price action ultimately likely had an impact on what was a reversal of many of those key policies. Importantly, the 90-day pause, the softening of the rhetoric around China, which is obviously central to this entire narrative, a softening of the rhetoric around the administration's approach to central banking, central bankers, and their respective independence. All of those messages softened quickly, And as a result, markets responded quite positively to that.
Having invested across many crises, what was your playbook for this one, and how did you approach managing risk versus deploying capital?
Critical to managing through a crisis is to come into the crisis with the right positioning, whether that means dry powder, risk-taking levels, excess capital, excess cash. But no matter how good we may think we are or how talented we think our team can be unearthing opportunities in a financial dislocation or a repricing or a crisis, it's very hard to do that without the ability to take risk or the ability to respond, which is really about the positioning coming into the event. So with the benefit of having gotten the first part right, we were able to kind of bring our whole team and our whole force and our whole history into deploying against what was a pretty major market move, both a repricing and a dislocation during the month of April. So the way that works here is, number one, it's fun and it's stimulating. The intensity goes up. The volume of meeting and interactions and exchange of ideas goes up. We're meeting nearly round the clock. We're meeting through the weekend, trying to surface ideas to be ready to respond to market pricing where we can deploy capital on behalf of our funds into what we think will prove to be exceptional opportunities. And so from a framework standpoint, what that means is we organize our global team and we bring everyone together across all asset classes and all regions with the following concept. Where can we find the efficient frontier of assets that are the highest quality, the least affected by whatever might be happening in the news, in this case, tariffs and secondarily cyclicality that would come from an economic slowdown associated with these high tariffs. So great assets, high quality, ideally unaffected by the heart of the matter today, intersected with most repriced and or most dislocated in that repricing. Said simply, where is the baby being thrown out with the bathwater? Where are we getting opportunities to deploy capital at what, with the benefit of hindsight, we hope looks terrific, and the opportunity is there because there is chaos in the markets. And so we line up those opportunity sets across our asset classes, across our strategies, across geography. We force rank that both top down and bottoms up. We develop a sense for, okay, what is the most repriced asset? What is the most dislocated repriced asset? What is the least affected asset? Where is that efficient frontier? And now, how do we find those individual opportunities and go deploy against it?
Given the breadth of asset classes that Sculptor invests in, where did you see cracks that unearthed opportunities?
So it starts, again, with process, and what we found to be hugely helpful historically during these periods of time is our ability to look across asset classes. It's very helpful contextually when looking at a bank loan or looking at what's happening in the high yield market to be able to compare that against what's happening in the equity derivatives market, what's happening in the private real estate lending market, even though that may not move as quickly, certainly, as the public markets. But it's very hard to look at risk reward in isolation, and it's very helpful to look at risk reward calibrated against so many flavors of it that are available across the world. And so once having created that barometer or set that benchmark for ourselves, we then go asset by asset throughout this period, and there were plenty of cracks. Now, to be clear, there wasn't a break in the system. There wasn't what we call a seizure in the financial plumbing, the type that we saw during the global financial crisis, the European sovereign debt crisis, the COVID crisis. It didn't quite get that far. It got close, but it did not get as far as that. So where were we seeing those cracks? We were seeing them in the typical places. We were started by seeing those cracks in parts of markets where participants are highly leveraged. and that tends to be the case historically. So if there is an opportunity set where the marginal setter of price is a highly levered player, that tends to be what dislocates or widens the most quickly during periods of time like this, especially if it has that component and it's more directly related to the current news flow. So parts of the convertible bond market, particularly those exposed to China, had significant dislocation. Parts of the equity derivatives market that tend to be participated in mostly by levered players, very significant dislocations. Equity options market, where during a panic, there tends to be a grab for downside protection, and no one cares about capturing the upside. That creates what is very dislocated skew in the options market during these periods of time. So where is there the most direct pain? Where are participants the most financially levered? Where is the intersection of those components and conceivably direct exposure to the issue itself? Again, in this case, tariffs, China, cyclicality. Away from that, where we were probably most active, and again, historically during periods like this tend to be most active, is in the credit world. And that comprises both corporate credit as well as asset-based finance. And a lot of ink is spilled about whether this time is different or next time will be different, or whether credit markets have fundamentally changed due to the shift from what used to be a mostly public credit market to today what is a half and half and maybe eventually mostly private market. But there's been a lot of talk about what would happen in stress to those markets. Will there still be an opportunity to deploy capital in credit? And I think what we saw in April is proof that the answer is yes. We saw significant opportunity, both from a repricing, again, at the index level, and we always use high yield as a benchmark because I think it tells us most of what one would need to know about the loan market, about the ABF market, about the real estate financing market, again, even about the private market. So there was a serious widening in high yield spreads, roughly 300 over, moved to roughly 500 over, which before the 90-day reprieve on tariff talks was probably closer to 600 over in the real cash market. So there was a real repricing, and within that, there was pretty significant dislocation in corporate credit markets, both the loan market and the bond market, in the asset-based finance market, again, secondary and primary. Usually during periods of time like this, the primary market is shut, and any issuer coming to the primary market, public or private, is only doing so due to a need or a lack of alternatives, because otherwise an issuer would choose to wait. But during these periods of time, there are companies, there are asset owners that happen to have bad timing. And if if a borrower needed to access capital during that period of time, obviously the price changed significantly and the terms changed significantly. So we were able to deploy across the whole platform pretty significant capital into the credit markets, both corporate and asset-based finance.
Most investors we speak with are wondering if we are out of the woods. The Fed recently announced that they're holding rates steady on increased uncertainty from Trump's trade wars. What's your view?
Well, part of our approach, I guess part of the answer is we never think we're out of the woods. But in a way, that's not particularly insightful for this moment in time. That's a general approach we take, and that's the always be watchful, always be cynical. Obviously, in an environment like this, the risks are more heightened because the policy volatility is record-setting, and the volatility around that policy is also pretty far-reaching in terms of what it could, in theory, do to the economy. So we don't expect most of this to come to pass. The market, frankly, no longer expects most of this to come to pass. But should some of these policies go into force, in a way, it's akin to a global trade embargo, meaning very serious economic consequences with very serious downstream effects across the board. I think what the administration has signaled, what the administration continues to signal, and what investors have largely absorbed is that whatever eventually gets implemented, if anything, is likely to be significantly less impactful than what was announced on Liberation Day and what came out post-Liberation Day during the retaliatory escalations that happened around the world. So where does that leave us? The events of the last couple of months have an economic cost, meaning that has created friction in the global economy, either with corporate confidence, CEO confidence, consumer confidence. It has delayed spending decisions. It has delayed CapEx decisions. It has delayed an individual deciding to book an airplane or a cruise, that type of decision. So there has been an impact, and there will continue to be an impact from the events of the last couple of months. Said differently, it's not free to have this level of chaos and uncertainty in the global economy and in global markets. Markets thrive on confidence, and they thrive on a sense of certainty. And without those two things, there is an impact on the economy. Whether or not it ends up being a recession or it ends up being simply a loss of growth is probably less significant long term, but there has been a cost. There will be a cost, but ultimately, trade will go on. There will, countries will find a way to make deals. Those deals will allow for companies to find a way to do business in a way that's profitable. There will certainly be winners out of that. There will be relative losers out of that, but the world will keep on turning and trade will continue to happen around the world, but there's a cost. The larger question, and I think the one investors are most fearful of, is not necessarily whether a trade war, so to speak, at this heat or this level continues forever. I don't think that's a primary concern. I think the concern is if the events of the last several months started a recession, can the recession be stopped? Or have we now simply moved to a new phase of the business cycle?
And given all of the events that unfolded in the early days of this administration, how does that impact how you invest going forward?
The range of outcomes is clearly wider than was anticipated by investors several months ago. There is the probability that even if the more escalatory trade policies go away, and even if trade deals are made around the world, something could happen in the interim that also has a negative effect on the economy. Meaning, global markets and global economies are a really complex system. And so introducing this level of uncertainty and this level of change doesn't always necessarily stay completely under control. Said differently, it could be hard to unscramble the egg. Now, our view is trade will go on. The economy will keep on going. It just might be at a rate of slower growth. And so that means underwriting to more conservative scenarios, being prepared for a recession, investing in credit where we believe we're going to continue to receive principal, interest, and amounts due at maturity, even if there is a recession. It means looking at companies in the equity market that we think are resilient to a slower economic environment or are already priced for a slower economic environment.
Given the investment environment we're in, what do you view as a key trend, opportunity, or challenge shaping how you approach investing today?
Well, certainly the policy volatility is a challenge, but that's also what's creating the opportunity. So there's always going to be a challenge in thinking about how to deploy capital. And 9 times out of 10, that challenge is going to be what is creating the opportunity to deploy capital. So I think key for us is not getting sucked into the day-to-day tweets, to the minute-by-minute news, to the watching the administration on TV and trying to parse each word. Because we know over time that the U.S. government and the current administration wants to be successful. It wants to be successful for America. It wants to be successful for American business. And so trade will go on, and deals will be made, and problems will be resolved. Again, there's going to be a cost to that, but keeping that framework in mind is very helpful for canceling out a lot of the noise, because predicting the next tweet or predicting the next move or predicting the next announcement is not only in our experience quite difficult, but it's also very time consuming. So if we don't think we can do it right, and we think it's going to use up all the time we could be using to find great investments, to make great loans, to do great deals, that's not a very good trade-off.
Great. Thanks so much, Jimmy. And thank you everyone for joining us.